The role of finance in the economy. Finance is the study of how individuals, businesses, and governments acquire, allocate, and manage financial resources. It involves understanding the processes of raising capital, investing, and managing risk. Finance helps allocate resources efficiently by directing funds from savers to borrowers, who can then use those funds for investment or consumption. This resource allocation process is crucial for promoting economic growth and development. A well-functioning financial system helps economies grow by facilitating the exchange of goods and services, promoting investment in productive assets, and enabling risk management. Financial development is linked to higher rates of economic growth, poverty reduction, and improved living standards. Finance plays a critical role in supporting the real economy by providing businesses and households access to credit, facilitating investment, and helping them manage risks. The financial system connects savers and borrowers, enabling the flow of capital and supporting economic activity. Financial intermediaries, such as banks, credit unions, and insurance companies, help channel funds from savers to borrowers and provide various financial services that promote economic growth and stability. Basic financial concepts: assets, liabilities, and equity. Assets are resources with economic value owned by individuals, businesses, or governments. Liabilities represent obligations or debts owed by an entity. Equity represents the residual ownership interest in an asset after liabilities have been subtracted. Financial instruments are contracts that give rise to financial assets for one party and financial liabilities or equity instruments for another party. Examples include stocks, equity securities, bonds, debt securities, and derivatives, contracts that derive their value from underlying assets. Market efficiency is the idea that financial markets accurately reflect all available information in asset prices. Efficient markets enable better resource allocation, as investors can rely on market prices to make informed decisions. The role of information is crucial in determining market efficiency, as access to relevant information affects investment decisions and price discovery. Financial markets facilitate the exchange of financial assets and the determination of their prices. They provide a platform for trading securities, enable the transfer of risk, and help determine interest rates. Their primary functions include liquidity provision, price discovery, and risk management. The time value of money, TVM, is a key concept in finance that refers to the idea that money available today is worth more than the same amount of money in the future. This is because money has the potential to earn interest or grow through investment over time. Present value, PV, represents the current worth of a future cash flow, taking into account the time value of money. PV is calculated using the following formula. And where FV is the future value, R is the interest rate, and N is the number of periods. Future value, FV, is the value of a cash flow at a specific point in the future, taking into account the time value of money. FV is calculated using the following formula. And where PV is the present value, R is the interest rate, and N is the number of periods. Discounting is the process of determining the present value of a future cash flow. It involves applying a discount rate, the interest rate, to calculate the value of the cash flow today. Compounding, on the other hand, is the process of determining the future value of a present cash flow. It involves applying an interest rate to calculate the value of the cash flow at a future point in time. An annuity is a series of equal cash flows paid at regular intervals over a specified period. The present value of an annuity can be calculated using the following formula. Where C is the cash flow per period, R is the interest rate, and N is the number of periods. A perpetuity is an infinite series of equal cash flows paid at regular intervals. The present value of a perpetuity can be calculated using the following formula. R, where C is the cash flow per period and R is the interest rate. Interest rates play a crucial role in determining the time value of money. When interest rates are higher, the present value of a future cash flow is lower, as the opportunity cost of waiting for the cash flow is higher. Conversely, when interest rates are lower, the present value of a future cash flow is higher, as the opportunity cost of waiting for the cash flow is lower. Financial markets can be broadly classified into three categories: money markets, These markets deal with short-term debt instruments such as treasury bills, commercial paper, and certificates of deposit. Money markets are characterized by high liquidity and low risk. Capital markets deal with long-term financial instruments such as stocks and bonds. These markets help businesses and governments raise funds for long-term investments and projects. Derivatives markets deal with financial contracts whose values are derived from the performance of an underlying asset, such as stocks, bonds, commodities, or currencies. Common types of derivatives include options, futures, and swaps. Financial institutions play a critical role in the functioning of the financial system. Some of the main types of financial institutions include: commercial banks accept deposits and provide loans to individuals and businesses. They also facilitate payments and offer other financial services, such as wealth management, credit cards, and foreign exchange services. Investment banks primarily focus on providing advisory services, underwriting securities, and facilitating mergers and acquisitions. Insurance companies offer various types of insurance policies to individuals and businesses, such as life, health, property, and casualty insurance. They help to mitigate risk by pooling premiums and paying out claims to policyholders who experience a covered event. Investment firms manage assets on behalf of their clients, such as individuals, corporations, and governments. They offer a wide range of services, including asset management, brokerage services, and financial planning. Pension funds manage retirement assets for individuals and organizations. They invest in various types of assets, such as stocks, bonds, and real estate, with the goal of providing a stable income to retirees. Central banks and their role in monetary policy and financial stability. Central banks are responsible for implementing monetary policy, which involves controlling the supply of money and interest rates in an economy. They also act as a lender of last resort to commercial banks and play a critical role in maintaining financial stability. Central banks can use various tools, such as open market operations, changes in reserve requirements, and changes in the discount rate, to influence interest rates and the money supply. Financial market infrastructure refers to the systems, institutions, and processes that facilitate the smooth functioning of financial markets. Financial market infrastructure refers to the systems, institutions, and processes that facilitate the smooth functioning of financial markets. Stock exchanges provide a platform for trading stocks, bonds, and other financial instruments. They facilitate the efficient allocation of capital by matching buyers and sellers and disseminating information about market prices. Clearinghouses act as intermediaries between buyers and sellers in financial transactions, ensuring that both parties fulfill their obligations. They help to reduce counterparty risk and improve the efficiency of financial markets. Settlement systems are responsible for transferring funds and financial instruments between parties involved in a transaction. They ensure that transactions are completed in a timely and secure manner. Functions of money in the financial system. Money serves three primary functions in an economy, which are essential for facilitating trade, investment, and overall economic activity. Money serves three primary functions in an economy, which are essential for facilitating trade, investment, and overall economic activity. Money is used as a medium of exchange, allowing people to buy goods and services easily. It simplifies transactions by eliminating the need for bartering, where individuals would have to trade goods or services directly with one another. Money serves as a store of value, meaning it can be saved and used for purchases in the future. It allows individuals and businesses to accumulate wealth and make investments. The ability of money to retain its value over time is crucial for its role as a store of value. Money acts as a unit of account, providing a common measure for the value of goods and services. It allows individuals and businesses to compare the relative values of different items, enabling them to make informed decisions about purchases and investments. Financial intermediation is the process by which financial institutions, such as banks, insurance companies, and investment firms, facilitate the flow of funds between savers and borrowers. This process is essential for channeling resources from those with surplus funds, savers, to those who need funds, borrowers, for various purposes, such as consumption, investment, or managing risk. By pooling funds from multiple savers and allocating them to different borrowers, financial intermediaries help to diversify risk, enhance liquidity, and promote efficient allocation of capital in the economy. The importance of liquidity and risk management in the financial system. Liquidity refers to the ease with which assets can be converted into cash without affecting their market price. A well-functioning financial system ensures that there is sufficient liquidity in the market, allowing individuals and businesses to meet their financial obligations and facilitating the smooth functioning of the economy. Risk management is another crucial aspect of the financial system. Financial institutions manage various types of risks, such as credit risk, market risk, operational risk, and liquidity risk, to ensure that they can continue to fulfill their obligations and maintain their financial stability. Effective risk management helps to reduce the likelihood of financial crises and contributes to a stable economic environment. Financial regulation plays a vital role in maintaining the stability of the financial system and protecting the interests of consumers. Regulatory authorities, such as central banks and other government agencies, establish rules and guidelines for financial institutions to ensure that they operate in a safe and sound manner. Financial regulation plays a vital role in maintaining the stability of the financial system and protecting the interests of consumers. Regulatory authorities, such as central banks and other government agencies, establish rules and guidelines for financial institutions to ensure that they operate in a safe and sound manner. Financial institutions are required to maintain a certain level of capital and liquidity to ensure that they can absorb losses and continue to operate in times of financial stress. Regulatory authorities monitor and supervise the activities of financial institutions to ensure that they adhere to established rules and guidelines, and they take corrective actions when necessary. Financial regulation aims to protect consumers by ensuring that financial institutions provide transparent and accurate information about their products and services, adhere to fair lending practices, and handle customer complaints and disputes appropriately. Financial regulators monitor and address potential sources of systemic risk, which can arise when the failure of one financial institution has the potential to trigger a domino effect and destabilize the entire financial system.